Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that made quite some reversal right here. Just the other day, we topped out around this resistance level here. And as we had the Federal Reserve announce new rate hikes, we saw the markets tank down aggressively within the matter of a couple of hours. If you watched our last video on the S&P 500, you'll know that's exactly what we talked about a few days ago, that we'd see the Federal Reserve begin to talk about tightening and that it would create some type of a risk-off move in the market, right as the market was beginning to build some pretty heavy divergence between the price and the RSI. But against what most people are saying right now online, whether that's on Twitter or on YouTube, calling for this to be the top of the market, expecting the Federal Reserve tightening to trigger an unprecedented bear market, thinking there's absolutely no way that the S&P 500 can still make higher highs while the Federal Reserve is tightening. I still think that we're going to get some pretty wild moves that we will be able to take advantage of as we get into this final phase of the bull run that we've had since 2009. We've broken out of this bull market price channel, and we're really on an unprecedented rally that I think is going to continue for another few months now. So by the end of this video, you'll know exactly why we might not quite be done with the volatility in the short term, and exactly the reasons why that might present some pretty big opportunities throughout the next few weeks that we will, of course, be covering on this channel. Now, if you're interested in following these crazy markets with us, make sure to click on that subscribe button. And now, without further ado, let's get right into it. All right, so let's take a look at that short-term technical picture first. This is a daily chart of the S&P 500 that has been trading within this beautiful price channel for quite some time. And you can see the last thing that we covered on the last YouTube video that we made on the S&P 500 was this divergence that we had between the price that was going higher and the RSI that was going lower. Now, that's typically a sign that you're going to get a correction. And if you're at resistance, which we were right here, we were testing this line of resistance and very close to the upper end of the range of the price channel. That leaves a lot of vulnerability for the S&P 500 to come down. And so, for example, you have the slightest bad news, the Federal Reserve says something a little bit hawkish, and you have the S&P 500 tank down. Now, normally I wouldn't expect a massive correction with just divergence like this. You can see throughout 2021, we had quite a little bit of divergence. For example, right here between these highs and this high, there was some technical divergence with the price going higher and the RSI going lower. It then only triggered around a 4% correction. Why is that different now? Why would there be more downside, potentially taking us down to the bottom of this channel and potentially to these levels of horizontal support? And I'm going to give you the answer to that question, because something that we do like to look at is the market breadth. Now, this is the S&P 500 stocks above their 200-day moving average, right? Let's zoom out a little bit. And this is just a beautiful indicator, and it's so important to watch because it tells you how many stocks are participating in a rally. When you have the stock market go up, and you have the breadth, so the number of stocks that are above the 200-day moving average also go up and stay high and make higher highs like the index. That tells you you're in a broad, healthy rally, that most sectors are participating, most stocks are participating in the rally. But now look at what's happened since that high in April 2021. We've had this deterioration in breadth where we've had this indicator come down significantly, make lower highs along the way, while the index has made higher highs along the way. So that's telling us that since that May 2021 low here, it's been a pretty weak rally from a breadth standpoint. Now think about how important it is, right? You have the stock market, so the S&P 500 trading at all-time high, so as high as it can possibly be, but you've only got 70% of stocks that are actually trading above their 200-day moving average, which is a key moving average. So that's some pretty big divergence that we have here. And another way of looking at it is by taking a look at the actual 200-day moving average on the SP 500. You can see where we're at. We're quite significantly above that moving average, while there's a significant portion of the stocks within the index that are actually below that moving average. So I think we get a partial retracement of this move here. I think we can get a move back down to that 200-day moving average right here before we resume this big bull run. Now, again, that would take us down to the 200-day moving average, which hasn't been tested since June 2020. If we jump on a longer term chart, you can see it's pretty healthy to test the 200-day moving average, right? It often acts as a significant level of support where the stock market can, take a break and bounce back off with strength. It can often create broad rallies from that test of the 200-day moving average. So that type of move, if we get that, and I think there's a non-negligible chance that we get that type of correction, that could cause a nice buying opportunity from a technical standpoint. And you can see, let's zoom in here, where that 200-day moving average is sitting. It's sitting just above this price channel support. Let's zoom out. This is a price channel that we've been looking at for quite some time. That's taken into account the entire bull run since 2009 that we broke out of in April, and that remains support, and it's currently coinciding with the 200-day moving average. Now that's just from a technical standpoint, okay? So we covered why, we could see a little bit more downside, the momentum divergence, the breadth divergence that really needs to retrace part of that move before we get a broad rally. And then another thing that we've talked about very recently is the fact that the Federal Reserve has not begun to tighten yet. And that's extremely important because it's only tightening that can cause bear markets and can cause recessions like 2008 and like the dot-com bust. That's what can trigger significant downside on the stock market. But you can see between the beginning of tightening and the recession, it's often a multiple year time lapse. So I think that's a narrative that a lot of people are getting wrong. They're confusing the beginning of tightening with the beginning of a recession. It's not the same thing, and there's often a time lapse in between. We have not had the beginning of the tightening cycle. We've only had a little bit of tapering, but what those people are getting right is that it's going to scare a lot of people, right? The beginning of tightening systematically creates risk-off moves in the market. We've talked about this before. I want to really press on that point because it's incredibly important. A lot of the day-to-day price action, the small swings in price, they're not really justified by anything other than what's happening in the news, what's happening with monetary policy, what kind of announcements we're having, and that can create a little bit of, additional volatility. And so with that Fed announcement hanging over the stock market, if we have a switch in momentum, we could have a little bit of a deeper correction than what we've been used to throughout the past couple of years. Now, another point that I briefly like to talk about is that time lapse that we just talked about, right, between the first rate hike and the recession. I think it's very possible that that time lapse is the shortest one we've ever seen. I think the economy is particularly fragile right now in the post-pandemic world, and I think the slightest amount of tightening is quickly going to have repercussions on the financial markets and on the underlying economy. But of course, that's a topic that we're going to be discussing in detail for future videos. If you're interested in following this with us, make sure to click on that subscribe button. If you enjoyed the video, make sure to smash the like button. Now, of course, that paints quite a doom and gloom picture. I am sorry about that, but it is just where we think we are in the cycle in the most objective way possible. We're seeing a lot of excesses, a lot of leverage, a lot of overvaluations, overextension. We're trying to navigate that as successfully as possible. We recently posted a premium video talking about the commodities cycle. We think that's going to be probably one of the most crazy investment opportunities this decade apart from Bitcoin. Being bearish on the stock market does not mean that we do not find attractive opportunities elsewhere. We have a detailed macro strategy that I think is going to make us come out of this period of economic and market volatility very successful. And we've also updated our trading watch list where the updates on each sector, on each asset are organized with the actual dates so that you can go and see what we said on particular dates. And of course, as we see this S&P 500 correction play out throughout the next few weeks, we'll be looking for aggressive long opportunities that I think is going to lead to probably one of the biggest rallies that we've seen in quite some time. So we're very excited about that. You can click on the link down below to check out our website and test out our free trial of the services that we have on here. Now that's about all I wanted to cover in this video. I hope you guys enjoyed. Now in the meantime, I wish you good luck on your trading and see you next time.